Hi there, and welcome to our video on top 10 safest option strategies, ranked from risk to safe. Today, we're going to take a deep dive into what these options trading strategies are and how they work, specifically for beginners. 1. Long call or put options. Buying a call or put option grants the right to purchase or sell the underlying asset at a predetermined price within a specified time period, requiring an upfront premium. The risk involves the potential loss of the premium if the asset price fails to reach or surpass the strike price before expiration, resulting in the option expiring worthless. Example: suppose an investor purchases a call option on stock XYZ with a strike price of $55 and a premium of $3, giving them the right to buy the underlying shares at $55. If the stock price rises above $58 by expiration, the call option becomes profitable, enabling the investor to gain from the price difference without being obligated to exercise the option. 2. Short call or put options. Selling call or put options without owning the underlying asset creates an obligation to buy or sell the asset if the option is exercised, with potential unlimited risk in the event of adverse market movements. This strategy is referred to as naked or uncovered option selling and entails substantial risks. Example: here's an example to demonstrate the risks of selling call or put options without owning the underlying asset. Imagine you sell a call option on a stock without actually owning the shares. The stock is currently trading at $100, and you sell a call option with a strike price of $110. You receive a premium of $5 for selling the option. 3. Bull call spread. The bull call spread strategy consists of buying a lower strike call option and selling a higher strike call option, aiming to profit from a moderate upward movement in the underlying asset's price, while minimizing costs through the sale of the higher strike option. Example: here's an example to illustrate the bull call spread strategy. Let's say you're bullish on stock XYZ, currently trading at $50 and expected to increase moderately in the near term. You decide to implement a bull call spread by purchasing a call option with a strike price of $50 for $3 and simultaneously selling a call option with a higher strike price of $55 for $1. By doing this, you've limited your potential loss to the $2 difference between the premiums paid and received. 4. Bear put spread. The bear put spread strategy is used to profit from a moderate downward movement in the underlying asset's price by buying a higher strike put option and selling a lower strike put option, limiting potential losses through the premium received from the sale of the lower strike put. Example: here's an example to illustrate the bear put spread strategy. Let's assume you have a bearish outlook on stock XYZ, currently trading at $50, and you expect its price to decrease moderately in the near term. To implement a bear put spread, you purchase a put option with a higher strike price of $55 for $3 and simultaneously sell a put option with a lower strike price of $50 for $1. By doing this, you limit your potential loss to the $2 difference between the premiums paid and received. If the stock's price drops to, let's say, $45 at expiration, the higher strike put option will be in the money by $10, but the maximum profit will be capped at $5, which is the difference between the strike prices. 5. Iron condor. The iron condor strategy combines a bear call spread and a bull put spread to profit from a range-bound market by selling higher strike call and put options while buying lower strike call and put options, aiming to capitalize on the underlying asset's price staying within a specific range. Example: here's an example to illustrate the iron condor strategy. Let's say a trader believes that stock XYZ, currently trading at $100, will remain range-bound between $90 and $110 over the next month. To implement an iron condor, the trader sells a call option with a strike price of $110 for a premium of $2 and buys a call option with a strike price of $115 for a premium of $1. Simultaneously, the trader sells a put option with a strike price of $90 for a premium of $2 and buys a put option with a strike price of $85 for a premium of $1. By doing so, the trader receives a net premium of $2. $2 plus $2, $1, $1. The goal is for the stock's price to remain between $90 and $110 at expiration, allowing the trader to keep the premium as profit. 6. Covered call. The covered call strategy involves owning the underlying asset, such as stocks, and simultaneously selling call options against it. By selling call options, you receive a premium from the buyer. This generates income, especially in periods of low volatility. Example. Here's an example of a covered call strategy. Let's say you own 100 shares of stock XYZ, currently trading at $50 per share. You decide to sell a call option with a strike price of $55 and receive a premium of $2 per share. If the stock price remains below $55 at expiration, the call option will expire worthless, and you keep the premium as income. 7. Collar strategy. The collar strategy combines owning the underlying asset with the purchase of a put option for downside protection and the sale of a call option to generate income. By implementing this strategy, the put option serves as insurance, providing a predetermined selling price if the market declines, thus limiting downside risk. Example. Here's an example of a collar strategy. Let's say you own 100 shares of stock XYZ, currently priced at $50 per share. To protect against downside risk, you purchase a put option with a strike price of $45 for a premium of $2 per share. Simultaneously, you sell a call option with a strike price of $55 for a premium of $1 per share to generate income. This collar strategy limits your potential losses, as the put option provides a selling price of $45, while the call option caps your potential profit if the stock price exceeds $55. 8. Protective put. The protective put strategy involves owning the underlying asset, such as stocks, and purchasing put options as insurance against potential downside moves. By buying put options, the investor has the right to sell the underlying asset at a predetermined strike price, providing protection in case of a price decline. This strategy helps limit the downside risk, as the put option acts as a form of insurance. Example. Here's an example of a protective put strategy. Let's say you own 100 shares of stock XYZ, currently trading at $50 per share, and you're concerned about a potential market downturn. To protect against downside risk, you purchase put options with a strike price of $45 for a premium of $2 per share. If the stock price drops below $45, the put option provides the right to sell the shares at that price, limiting your potential losses. 9. Cash secured put. The cash secured put strategy entails selling put options while maintaining sufficient cash reserves to buy the underlying asset if the options are exercised, generating income from the premiums received and obligating the investor to purchase the asset at the strike price if exercised. Example. Here's an example of a cash secured put strategy. Let's say you're interested in buying 100 shares of stock XYZ, currently trading at $50 per share, but you believe it could decline in the near term. Instead of purchasing the shares outright, you decide to sell a put option with a strike price of $45 for a premium of $2 per share. You ensure that you have enough cash in your trading account to cover the potential purchase of the 100 shares if the put option is exercised. 10. Long-term equity anticipation securities, LEAPs. Long-term equity anticipation securities, LEAPs, are options contracts with expiration dates typically extending 1 year or more into the future. They offer investors the opportunity to participate in the price movement of the underlying asset with a limited initial investment. Example. Here's an example of long-term equity anticipation securities, LEAPs, strategy. Let's assume you are bullish on stock XYZ, which is currently trading at $100, and you anticipate a significant price increase over the next year. Instead of purchasing the stock outright, you decide to buy LEAPs call options with a strike price of $110 and an expiration date 1 year from now for a premium of $5 per share. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.